on a yacht somewhere rather than in this studio answering the question.
Not be working here, for sure. You know, there's this old joke about economists and how economists have predicted 9 out of the last 5 recessions, which just means that people rarely get this right.
Yeah.
Right? It's people predict one and one doesn't happen, or they don't predict it and then it does happen. So, you know, with that as a benchmark, we can at least try. So I don't know whether there's going to be a recession. I don't think it's certainly not inevitable, but it could happen. What we do know is that we have, you could think of it as recessions in sort of segments of the world economy. So trade is hurting because of the trade war. So trade and, you know, some parts of the global trade flows are contracting. So you could sort of talk of a trade recession. Most goods that are traded are manufacturing goods, right? There's goods are traded more than services. And there is a manufacturing recession in the sense that manufacturing production is contracting in Europe, in the US now. So for one part of the economy, there is a contraction. And overall, of course, there's a slowdown. The world economy and most big economies have been slowing down for the last year, even more. And the question, does that slowdown go all the way to 0 and below? That's the big question. What do you think?
Well, I mean, like you, I don't have a crystal ball. I don't know the definitive answer, but it's certainly a question that people in markets are asking increasingly often, not least because we've just been in this bull run for such a long time. Ever since the crisis of 2008, markets have been pretty benign. They've been juiced up by lots of central bank support. And now we're at the point where people are sort of looking at their watches and thinking, aren't we sort of due a bit of a pullback? So people start casting around and looking for reasons to worry. Now, clearly, a very big reason to worry is trade, as you say. The number one thing that comes up in discussions with economists and investors around the city is about what's going on between the US and China. Now, what's your sense? Do you think that this is a genuine reason for caution? Or, I mean, it's clearly a reason for caution. Is it a reason for panic? Or do you think that both sides will back away before they really go all in?
There are a lot of people who benefit from trade.
Yeah.
Right? There were very few people who were calling for an outright trade war before basically President Trump launched one. He has his political motives. He also has a lifelong belief that the US is being ripped off by, well, earlier it was Japan, now it's Germany. It's also, now it's China. It's also Germany. And, you know, it could well move to Europe at some point, his target. But you also see his sort of pattern of making a lot of chaos and then striking a deal that sometimes looks very much like what he had before. This is what happened in the trade negotiations with Canada and Mexico. You know, speculatively, my bet is that when it's politically convenient for him, he will, you know, declare victory. There will be some changes to the trading relationship between the US and China, but it will be back to something more or less similar to what we had before. But I think there's an outside chance that there are by now enough protectionist forces in the US that really want to kind of bring back these global supply chains that have developed over the last 30, 35 years. The US is a big enough economy that it can kind of go it alone. It'll be less rich as a result, but, you know, it can do it. It's a huge economy. But that's going to be a big political fight that isn't just about Trump, but also inside the Democratic Party. There are different opinions about trade with China. So it's an open question. I think the probability is that at some point when it's politically convenient, it will quiet down and we'll get back to, not quite the status quo ante, but something that looks pretty much similar to what we're used to.
And then we can just stop talking about the whole thing.
We can find something else to worry about.
Something you've already brought up is manufacturing. And this is obviously first in the line of fire when trade wars really get fired up. And we've seen that, I think we've got some charts to demonstrate this that we should be able to get on the screen for you, that this is really showing the strain now. There's a large part of the world that is showing that manufacturers are getting incredibly nervous. One of the things that you hear a lot about in this situation is PMIs, Purchasing Managers Indices. Basically, there are companies that go around calling up companies and saying, hi, how's business? How's it going? What are your orders like? What's your hiring schedule like? What are your inventories like? How are you feeling about the next few months? And that produces these indices called PMIs. And they're a really good indicator of how worried people are. And so, you have to kind of know what you're doing when you're looking at these PMIs, what they are telling you and what they're not. But when you get a number that's under 50, that is their way of saying, that's the indices' way of saying, yeah, we're now looking at a contraction. And there are lots of spots around the world. You look at Germany as obviously the big example in Europe, but there are lots of places around the world where company executives are saying, yeah, we're worried. This is hurting. I mean, how much of a feed through is that to the bigger picture for you?
Well, that's exactly the question, because manufacturing, making things, it's still important, but it's actually not a very big part of rich economies.
Yeah.
So maybe 20%, depending on the economy. Most people don't work in factories. Most people don't make stuff. They work in services. They could be retail services, shops, cafes, restaurants, or they could be the sort of services that make the economy go round, but you don't see them on the high street or on the main street if you're watching in the US. Accounting, legal services, all sorts of expert work, and the university sector, research. All of these are services, and that makes up roughly 80% of the economy. And so until now, this slowdown that you've just described, and an actual recession in the manufacturing sector and industry, the big question has been: is this going to feed through into services? And most places that hasn't happened yet. It's kind of it's uncertain. It's not really booming anywhere, but services seem to be holding their own in most places. There are sort of small signs. In Germany, services have started to come down a bit. In the UK, quite a bit. Still doing a lot better than industry everywhere. But we don't know. What we do know something about is how it could happen, right?
Yeah.
And some of it is because factories, the manufacturing part of the economy, are customers of services. So, if your factory doesn't sell its goods, then it's not going to buy services from service businesses around. That will hurt. Or it can be a confidence thing. Everyone sees trade war, factories closing. Well, we'd better watch out and not spend money.
Yeah.
And that affects and spreads through the rest of the economy. That's how it would happen.
Yeah. We've got a question here from Robert Dukes. Do central bankers and governments take preemptive action to avoid recessions if the curve inverts? Now, by the curve inverting, what he's talking about here, yes, exactly. So one of the big reasons why this question around whether there is a recession at hand has really shot up the agenda is basically that the bond markets are flashing red. They are saying you need to be worried about what's going to happen next. So the super safe stuff in markets, government bonds, have absolutely rocketed. Pretty much anyone with an interest in markets will be able to tell you that yields are now yet negative on $16 trillion worth of debt around the world. That means
this is what we always have to remember, right? When the price goes up, the yield goes down. So very low yields means a lot of people want to hold these things.
It basically means that people are so desperate for safety that they're prepared to take a guaranteed loss on what they buy to be able to just have some safekeeping of their funds. And we've also seen this famous inversion of the yield curve. Now, generally speaking, this is an excellent indicator of what's going to happen in the global economy next. But basically speaking, yes, it should cost governments more to borrow for the long term than it should for the short term. So your yield curve should generally point higher. And what it's doing now is pointing lower, which means that there's basically just massive demand for all types of debt. And this is crushing yields for all sorts of different maturities. And this sort of inversion, this funny shaped curve, as we call it, is a real cause for concern. What's your sense of whether it is a slam dunk indicator of a recession? Because it's a huge debate.
Yeah, exactly. And that's why places like the FT, we talk about recession fear so much because of these signals, right? So, in the markets now, people are willing to accept lower interest rates to lend for 20, 30 years, 10, 20, 30 years than for 3 months.
Yeah,
it kind of sounds crazy.
The entire German yield curve is negative now.
Right, and sloping down, right? And the yield curve is a much better predictor than economists are. I made that joke at the beginning that economists sort of mispredict. I mean, you know better than me, but I think the yield curve in the US at least has been pretty much every recession has been preceded by an inversion of the yield curve. And there can't have been many cases of the yield curve inverting without a recession following. So it looks like a slam dunk, but actually I don't think it is. And this is a dangerous phrase, but this time is different. This time is different in that in the last 10 years, central banks have been buying a lot of long maturity bonds. So they're in there buying. They're driving the prices up, driving the yields down, which is intended, right? Central banks go out there buying this stuff to make it cheaper for companies to borrow.
This is a feature, not a bug, yeah.
It's a feature, not a bug, but it also means that you can't really take the difference between short-term rates and long-term rates as a pure market signal. It's a result of policy. The Bank of Japan explicitly targets both the short-term and the long-term rate. So it's just a function of policy. The short-term rate is, what is it? The short-term is -1 and the long-term is -0.1 and the long-term is 0. So it's just built in as a result of policy. So unless you're saying that this policy will lead to a recession, I don't think it has the same predictive power that it used to have when it was just the result of judgments in the market.
And going back to this question that we received, will central banks try to get ahead of recession? That's precisely what's happening here. We've had not so much hints from central bankers as kind of waving great big signs in the air from central bankers saying, inflation is just not coming up like we thought it would as a result of all the policy that we've been pouring into the system for the last decade. We have inflation mandates, which means that we have to target a certain level of inflation, generally speaking, around 2%. And so we have to do what our mandate tells us to do, which is just keep on easing. And with interest rates basically at 0 or even lower in a lot of places, that means buying more bonds. And so the market is getting ahead of those extra bond purchases. That's kind of what markets are for. Now, one of the phrases that keeps coming up in my conversations with people in markets at the moment is over their skis. There is this idea that the bond markets have just lent that little bit too far forward. They've priced in enormous bond purchases, in particular from the European Central Bank, but that's kind of trickled throughout the system. And there is a bit of a sense now that unless central banks really deliver some really heavy-handed extra bond purchases, maybe the bond market has run a little bit too far ahead of itself. Would you be surprised to see a bit of a pullback from the markets if the central bankers don't do quite what we're expecting them to?
I think that's possible. As you say, the biggest, where this is most visible is in Europe, where the European Central Bank meets this Thursday to decide what to do, but they have signaled very heavily, Mario Draghi, the president, and some of his allies on the Governing Council, that they will put together a pretty big package. Now, in the last couple of weeks, some of the hawks on the Governing Council have said, well, maybe we don't need to, and they try to damp down expectations a bit. So I think maybe markets are a little bit less certain than they were a couple of weeks ago that something big was coming. But what you're saying, I agree with, that it has to be pretty punchy. Otherwise, market will say, we expected something more. Let's sell off, and interest rates could go up, even if the central bank actually tries to push them down. But what does that do to the economy? I think that depends a bit on what the final result is. So yields have been driven down in expectation of central bank action. Maybe they'll go back up a bit. Still, if financing conditions for consumers and home buyers and investing businesses, if that's still a loser at the end of the day, then I think that will be a stimulus. So in the end, that could stop the slowdown, maybe return, the ideal is to get optimism back so that people start spending again and you start to push growth back up. That's a tall order, I think, because you sort of see this negative momentum. But it's up to central banks and governments with their budgets to try to stop this slowdown from becoming self-fulfilling.
Yes. One wrinkle here, of course, is that this global, effectively, policy of negative interest rates is a worry for some banks. Now, where do you think that fits into the equation here? Do you share this idea that central banks are so desperate to avoid a rerun of 2008 that they're throwing everything at this issue, and actually we could be at the point where that starts to make issues worse by making it harder for banks to operate?
Yeah, I mean, I think the first bit of that, being desperate to avoid 2008, would be a really good thing.
Yeah.
Although it's a different situation. There it was a financial crisis that caused, a bubble that burst, and that caused a recession. That's not what seems to be driving things now. So, let's keep the differences in mind. It's not just the sort of size of the problem. But it is good to want to forestall a recession. So I think that's a good thing. The other part of your question was, can they push things so far down that actually could be counterproductive? And so there are some people who say that, well, if you have interest rates far too low, then banks start to struggle and then they stop lending rather than lending more and actually get the opposite of what you want. I don't actually think so. I think what we've seen so far doesn't bear that out. But I also think that we haven't gone as far as central banks could do. So in a sense, this is literally uncharted territory, right? Unexplored waters, call it what you will. We've never done this before.
Yeah.
So there's a lot of theorizing and speculating and saying, well, here's one thing that could happen for this reason, here's another thing that could happen for that reason. The empirics so far, what's actually going on in the economy, doesn't signal that we're going to get these perverse consequences.
Yeah.
Is it possible? It's possible. But central banks haven't pushed things so far that we see any signs of that happening. So I think, until you actually see it happening in the banking system, I think they shouldn't, let these worries stop them from acting.
We've had an interesting question here. Is it a danger that we're relying on China for economic security? Now, I think, again, we've got some charts that can demonstrate that there has been a slowdown in India and in China. And it's interesting also when you speak to fund managers over here in London, or especially like on the continent in Europe, they say, Brexit doesn't even really get through to them in terms of the risk that the UK could crash out without a deal, for example. This is going to be a UK problem for the UK. The country that they've got eyes on really is China, to think, can China keep the show on the road? Can it keep throwing stimulus into the system over there to stop the Chinese economy from contracting, well, slowing down at least?
Yeah.
Now, the People's Bank of China, the central bank, is constantly throwing things into the mix, looking at things like reserve requirements at banks, how much money they have to set aside against what they lend out into the system. They're constantly doing things to keep supporting growth. Are you expecting them to keep doing that? How long can they do it for?
Well, I think they will want to try to keep growth going. The difficulty is that there are two problems, really. One is, can you keep pumping in either debt or government spending, money creation, all of these tools that everyone has used? And, to the question, it's quite correct to say that we relied on China kind of in the recovery from the global financial crisis. In the early 2000s, Western economies built up debt and drove demand growth that way. The financial crisis happened and they stopped. But China picked up the slack and started building up debt on its end, and that created demand in the global economy. Now, at some point, you kind of run out of road with that. The other problem is, of course, that China's growth model has been based on these trade links that are now under threat. So there's a supply side problem too. So if your economy is geared towards producing consumer goods for US consumers, and that stops, it's not, you don't automatically, you can't just pump up that without changing your economic model. So there are two big and very difficult things going on. Now, China can probably cope. China is still a sort of largely contained domestic financial system. So yes, there could be a huge debt crisis, financial crisis in China, but the government has the means to deal with that. They could write down debt, they could rescue whoever they want to rescue. It is manageable. It could be ugly, but it's manageable. So I think they still have more tools. But I think also other economies can do more on their own, the Eurozone and Europe in particular, where the Eurozone and the core economy, Germany, have been very happy to just ride this wave of export demand. The Eurozone is very imbalanced in the sense that it has a large external surplus. It exports, it produces more than it consumes. But it could stimulate consumption at home more and just produce for itself. That's something it could do. It would take political change. It would need Germany in particular to change the focus of its own economy. But, it's possible. It's politically difficult more than it's economically difficult.
I mean, that sort of links to one of the things that again, I keep hearing, which is that some of the big ingredients for a recession are just not there. For a global recession, are just not there. So yes, the bond market is doing funny things, but quite honestly, the bond market's been doing funny things for most of the last decade. It's just doing them in a slightly more funny fashion now. Yes, there is a trade war. This is a chronic, long-term issue that's going to run and run until it either fizzles out or goes horribly wrong. But some of the big ingredients, like a massive bank failure, like look at Lehman Brothers, it's not obvious where that would necessarily come from, or a huge market dislocation. a massively misvalued thing somewhere that could just blow up that nobody has predicted yet, which again seems unlikely given the amount of time and effort that people have done scouring markets for signs of something that's going to go wrong. Or a massive run-up in interest rates from central banks who've already demonstrated that they're determined to do the opposite. Or a huge burst of fiscal tightening from governments around the world. And as you say, the pressure from multilateral agencies like the IMF, for example, on individual countries is, come on, Germany, open your wallet. We know this is going to be painful. We know this isn't how you roll, but open the wallet, get spending. Actually, a burst of fiscal spending around the world might be just what we need. And you're starting to hear that conversation come through in the States, for example. You know, a lot of the candidates that are looking to challenge Donald Trump are saying, what if we actually spent loads of money on a green agenda that could be economically beneficial as well as environmentally beneficial?
And he himself did it, of course, not on the green agenda, but on tax cuts.
Well, exactly.
One reason the US has done so well over the last couple of years is because a lot of, the deficit has grown. They've just put a lot of government money into the economy or taken less out in taxes.
So is your sense that this is going to become more prevalent, particularly in Europe?
I think it could. I agree with you that the normal causes of recessions are not so easy to see. It's either a financial collapse, but again, it's not as bubbly, even though prices are high, it's not as bubbly as it was in 2007, 2008. The one thing people worry about, corporate debt, is just not the magnitude that seems to trigger something of that order. And the other main reason is that either central banks or governments have caused a recession by stopping the flow. The Eurozone did this. When everyone else was recovering after the global financial crisis, the Eurozone tightened monetary policy, increased interest rates in 2011, and had a huge swing in the government budgets from expansionary to contractionary to the austerity programs. And they may not all have admitted it, but they've all understood that that is what caused the double dip, the second recession in the Eurozone. It was entirely self-inflicted. So, yes, I think what you're suggesting, I agree that there's a sense that that can't be allowed to happen again. You have a new EU Commission coming in November 1st. They will sort of have the political capital to take, they don't need to come in doing any consolidation. If anything, they will need to come in trying to restart growth. And even in Germany, there's a lot of talk about how do we get around these fiscal rules we'll place on ourselves so that if there's a recession, we can actually stimulate a bit.
If Germany's talking about it, there's something going on.
Exactly.
We could talk about this all afternoon, but we're not allowed. Martin, thank you so much. We have to leave it there.
Thank you, and thanks to the viewers.